So you would think, well, that means Bitcoin's going to peak in the first quarter of 2026.
Yep.
Not so fast, because what happens is Bitcoin lags by about 3 months, by about 10 to 12 weeks. So now Bitcoin's going to lag that. So if all things being equal, you don't have a market shock, which takes everything that I'm talking and
throws out the window.
Right out the thing. Yeah, exactly. But if we don't have a market shock and we just keep doing what we're doing through the end of this year, then I think that Bitcoin's going to peak out somewhere in the first quarter of next year to half, like the first quarter, the first half of next year, it's going to peak out. I think we're going to be 150, 180 by the end of this year. I don't know where the top is, because I'm not the guy who says it's going to be 1 million this year, but I don't know. It's Bitcoin. I mean, I might be wrong.
The Bitcoin market has a rhythm, one shaped by halving cycles, liquidity flows, and investor psychology. Every 4 years, the block reward gets cut in half, creating a supply shock that, historically, sets the stage for parabolic price moves. But these surges don't happen overnight. While many newcomers expect instant fireworks, seasoned observers know the real price action often lags the halving by several months, as the market slowly digests tighter supply and rising demand. James Lavish offers a grounded take on what might lie ahead. Instead of predicting an immediate explosion post-halving, he expects Bitcoin's peak to unfold gradually, possibly during the first half of next year. Based on past cycles, there's typically a 10 to 12-week delay between the halving and the real top. That means the initial months of 2025 could see Bitcoin quietly push toward new highs, assuming no major macro shock knocks things off course. Lavish estimates the price could hit $150,000 to $180,000 by the end of this year if current trends hold. Still, Bitcoin has a way of surprising everyone. Lavish isn't one to throw out wild six-figure predictions without caution, but he leaves the door open. In moments of euphoria, markets behave irrationally, and with Bitcoin, that's almost part of the design. Let's watch clips from James Lavish's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
When you talked about the issues of institutional adoption then, are those issues now no longer relevant? Do you think that kind of red tape has been removed?
It has, with the ETFs. One fell swoop. It was so fast. That's the operational issue. Because, you know, when you're an institutional investor, you've got fiduciary responsibility, and then you've got like this personal risk as well when you're doing this stuff, which is professional risk. So you've got to, you know, perform your duty, and you can kind of hide behind that sometimes if you don't want to take on this professional risk. What do I mean by that? I mean, if you're going to buy Bitcoin, real Bitcoin, and you're gonna have your key phrase. Well, okay, well, who's gonna take control of that wallet, that signing device? Is it going to be you? Or are you going to do it with a chief investment officer? Or are you going to have your legal counsel involved? I mean, like, that's just the first thing.
Yeah.
You know, like, how is that really going to work? And that's actually what people think about first. But when you're sitting in those meetings, that's kind of down the line. It's first of all, it's like, what is this thing? Where does it trade?
Am I willing to take career risk?
Well, yeah, because that's first. Like, even if you think you love it, even if you're an investor and you know, portfolio manager who understands it and gets it and loves it, wants to invest in it, the problem is, where are you going to trade it? Coinbase, Kraken, like, what are these things? Back then, 2021, yeah, Coinbase was there, but institutional wise, it was, you know, we don't really know. Then you had FTX happen, everything. So it was really sketchy. And so, so that was just a big hurdle to get over. And then who holds it? Like, you don't custody normally. So what these institutions love is they love having custody taken care of for them through, you know, at least with the big banks and hedge funds, they want like their prime broker to take care of that for them. The highest rating in debt is AAA. That's prime, right? And so the U.S. was always, you know, I mean, it's the global reserve asset, right? The U.S. Treasury. And
You
so
surely can't get better debt.
surely you can't get better debt. Like, this is riskless. Like, this is supposedly the 10-year U.S. Treasury is supposed to be riskless.
Yeah.
That's the point. Well, then we had a couple of things happen, and one of them was a budget battle. And I believe it was S&P that downgraded them first, if I remember correctly. So they downgraded not because they think that the U.S. is going to default and not pay the bonds. So this is where people get a little bit tripped up. AAA is like, there's no risk whatsoever that you're ever going to default, right? Then you've got AA, which is, it's like as close to AAA as you can be, obviously, but there's something there. Okay. So why would they downgrade the US if they're never going to default, really? And even when they did default because of this budget battle, it was back in, I want to go back and, I've got the newsletter here, so I don't want to quote the wrong time frame, but it was, 1979 is when they technically defaulted. So what happened? So they were in this budget battle, and back in 1979, everything was done by paper, right? So they're in this battle, and the congressmen are going back and forth. They're fighting about it. They didn't want to raise the debt ceiling. Finally, they get to a solution and they raise it, but it was at like the midnight hour, and it didn't give the Treasury enough time to stamp the envelopes and get them out the door with their interest payments. And so they tripped a payment, and they made it up really quickly. They made everybody whole, but technically they defaulted. So that's what we're talking about here. Because, Lynn talks about all the time is like, if you're a sovereign that issues debt in your own currency, you would never default. You'll just print more currency and buy the debt to make sure that you're not defaulting.
Yeah.
And so, but the technical default is that you trip a payment and then you make everybody whole later, which is what happened in 79. Back in 2011, it's the same kind of thing happened. That's when S&P, so it was Fitch who did it first, and S&P did it.
Did what?
No, I'm sorry. S&P had downgraded the U.S. first.
In 2011, after the financial crisis.
And yes, in 2011. Then 2023 is when Fitch joined them.
Okay.
Yeah. But why does that matter? And why do you see that? So you see bond investors get worried about this. And how do you know that they're worried? Well, you see term premium. You see premiums that meaning that the debt trades at a higher yield than it normally would. Because you can calculate it out. The term premiums are somewhere around 80 basis points or 90 basis points right now for the 10-year. It should be higher, but we'll get to that in a second. But the reason that you have that is because investors are concerned about inflation, and just this deluge of debt. Who's going to buy all of it? Which means that they want to be compensated for that deluge of debt that's coming. We're seeing that. People are a little bit worried about inflation, which gets us to stagflation. We can talk about that in a minute. But the people are concerned about that. Investors are concerned about that. And bond investors are like, they don't want to buy 10-year, 20-year, 30-year treasuries and have what happened back in 2022 all over again, where, interest rates go up, the bond is worth less, and they're sitting on this portfolio of marks that are, down 20, 30% again.
Yeah.
So how do they compensate themselves and protect themselves? Well, they demand a higher rate. And this is where the bond vigilantes come in. Bond vigilantes are the ones who are saying, no way. And it's not like a group of, it's just that investors are looking around. Yeah, they're looking around. They're saying, we need a higher rate here.
Yeah.
And they're not colluding, but they're recognizing each other like, I need a higher rate too.
Everyone's seeing the same thing. Right.
So then you get this term premium. And the last piece of that, so you've got inflation, worry about interest rate risk, concern of interest rate risk because of both inflation and because of the deluge of debt that we know is coming. I love Doge. It's great that they're getting rid of fat and and fraud, but they're not going to balance the budget.
Of course,
it's just not going to happen.
That seems more clear than ever right now.
You're right. I mean, I've been saying this for since the start. It's like it's too much. The math is not going to work. So, but that's fine. The issue here is that the last part of that is now you've got this deeply divided political faction, right? So you've got the Democrats and the Republicans they almost can't even they can't even speak. Like it used to be. Back in the 80s at least, and the 90s, they could at least talk across the aisle and really kind of be reasonable. Totally,
that's out the window.
Irrational. Like they're totally unreasonable between the two parties now. So that means that each party is trying to trick the other one into making cuts into their programs to hurt their constituents to get fewer votes. We know that. It's the way it works. But the issue here is that they're so entrenched in the battle that the risk is that we go right up against that window again, it closes and we trip a payment. Of course they'll make it up, and they will make everybody whole, and they won't fully default. It'll be a technical default. Then why do the credit default swaps on the US bonds start to get more expensive?
Institutional walls are finally cracking as ETFs sweep away the red tape that once kept Bitcoin out of serious portfolios. At the same time, trust in US debt is slipping. Credit downgrades, political dysfunction, and technical defaults are shaking the foundation. Bond markets now demand higher yields, signaling deep concern. In that chaos, Bitcoin isn't just surviving, it's gaining ground. When the old system looks shaky and divided, hard-coded, scarce assets start to look less like a gamble and more like a lifeline. The cracks in America's structural privilege are widening. For decades, the US dollar's reserve status allowed reckless fiscal policy, spending far beyond its means, cushioned by global demand for dollars and treasuries. But that global patience is thinning. Investors are watching volatility, short-term debt reliance, and political dysfunction pile up. Meanwhile, Bitcoin's fate may hinge on liquidity cycles. As global credit systems stretch and distort, hard assets like Bitcoin thrive when money flows. With liquidity expanding, many see Bitcoin approaching its next major peak in 2026. Let's watch more clips from the interview.
In the newsletter, you said structural privilege is being reevaluated, and I wasn't 100% sure what you meant by that.
Well, I mean, meaning structural privilege, being the global reserve currency, gives us privilege that we get to run all these deficits with the global reserve asset because fiscal deficits, trade deficits, fiscal deficits. So meaning that our government spends more than we create through GDP, right? So, which means our tax dollars are lower than what we spend. So the structural privilege is that, well, because we have the US dollar, well, we can be irresponsible over here with our spending because everybody needs dollars. So, and almost have to be because everybody needs dollars. They need debt to use it. As we need to keep, we just keep issuing debt. And so the privilege is we get to overspend. Everybody has to get these dollars that are being debased rapidly. And that's the privilege. It's structural. And it's now people are looking and saying, hold on a second, time out. Is this really the way we want to, do we really want to own these?
Yeah.
Truly. Michael Howell argues that he just put out a newsletter this last few days, and he argues that the 10-year should be trading above 5% already. It's at 4.5%. But he's like, the 10-year should be trading above that because the issues that we have are they're actually being swept under the rug by the way that we're issuing bonds. And what I mean by that is that Scott Bessent criticized Janet Yellen. Really, he was really critical of her over the last few months before he took over in the campaign. But he was really critical that she had not termed out the debt.
Yeah, she'd been issuing everything on the short.
Everything on the short end. So for your listener, meaning they didn't issue a lot of 10-year, 20-year, 30-year debt. They stayed in the short belly to the T-bills.
Like the 1 to 3 year kind of range.
Correct. And so, or even less than that. So now you have all this debt that's being issued on the short end, which makes it easy for investors to buy because there's really no duration risk or interest rate risk, so you can buy those easily. And so, but it's artificially, it's kind of QE. It's kind of yield curve control.
Because those bonds are more money-like than the long duration.
Correct. They're treated more like money. The money market, when you buy a money market, on your Fidelity account, you're buying bonds. You're buying T-bills. That's the money market and the repo. That's what you're buying.
How do you see the next 12, 18 months playing out for Bitcoin?
I think it all has to do, and I this is where I do agree with Michael Howell. from cross-border capital is he looks at the assets like gold and Bitcoin and really attaches the cyclical values of that to the cyclical expansion and contraction of liquidity. Okay, why is liquidity matter? Everybody talks about M2, and that is very important. It's part of liquidity. But what liquidity is, we're living in a debt like structure economy. So the whole world, it's not just the U.S. I mean, our whole foundation is built on borrowing, leverage, and debt. And so that means that you must have expansion of leverage and debt to keep going.
Yeah.
By definition. So what happens is you're looking at this cycle of liquidity, and that's a whole bunch of things. And again, it's like it's the amount of it's central bank liquidity, QE, that kind of stuff, or acronyms that create liquidity, or not terming out debt, that stuff. It's shadow banking, which is like hedge funds,
and like the euro-dollar market.
Lending, the euro-dollar. It's all of that stuff. And some of the factors that go into that are not just the amount of bonds that are out there or whatever, but it's the amount of collateral that is needed to borrow. And so when you have volatility in the markets, the increase in volatility means that you have an increase in margin. Why is that? Because when you have a really big increase in volatility, it's usually because you're seeing drawdowns. And so you have the banks and the prime brokers raise the minimum collateral, which is called the haircut. So if you're going to go buy a stock, you're going to go buy an Apple or Microsoft and blue chip S&P stock. You would typically have to put down 6% for that, and you would get portfolio margining on the rest of it. You could borrow 94% against it. But then in times of shock or times in high volatility, that 6% might move up to 20, 25%, which we saw in the great financial crisis, even in blue chip stocks. And so that means that you need more liquidity. You need more collateral for that borrowing, which brings down the borrowing because you're obviously going to sell part of your position to get enough collateral to secure that position with your lender. And so that draws liquidity out of the market. So when you see high volatility, that's not good, especially in bonds, because bonds are the base asset to borrow against in repo markets and shadow banking repo markets, not just with the Fed. And so that's bad. When you see the MOVE index get higher, that's bad for liquidity.
About this. Yeah.
Yeah. So, and that's the issue, right? And so, I think Jack and I have talked about it. So that's the issue, and that's part of the calculation. Okay, so this goes back to your question, what do I think is going to happen with Bitcoin this year? Well, I still think that we're expanding liquidity, and you can see it. You've seen liquidity expanding recently. And so, and Michael's studies have shown that liquidity goes in 5 to 6 year cycles. The last cycle bottomed out, and it's going to be 5 years coming at the end of this year, I believe. So his point is that liquidity is going to peak at sometime in the first quarter of 2026.
With Bitcoin hovering around the $105,000 mark and having briefly touched $111,970 in late May, market analysts now eye a potential breakout above $115,000 by early July. This bullish outlook hinges largely on institutional demand and upcoming U.S. job data. If the June 6th report reveals a cooling labor market, it could prompt the Federal Reserve to consider rate cuts sooner, weakening the dollar and boosting Bitcoin's momentum. Conversely, a stronger-than-expected report may trigger a pullback toward $102,000 or even the $95,000 range, where accumulation zones await. James Lavish recently highlighted how Bitcoin's trajectory is closely tied to liquidity cycles, 5 to 6 year macro patterns that shape capital flows across all asset classes. According to him, the current liquidity expansion is likely to drive Bitcoin's next peak in early 2026. This aligns with Bitfinex analysts who view the current market dip as a temporary correction rather than a reversal, especially as ETFs attract billions and sentiment holds firm. As regulatory uncertainty fades and institutional pathways open, Thanks to ETFs and improved custodial infrastructure, the barriers that once held back Wall Street are rapidly crumbling. The convergence of technical tailwinds and macro liquidity trends signals that Bitcoin isn't just in a bull market, it's in the early innings of a global revaluation cycle. And as always with Bitcoin, timing the top may be nearly impossible, but understanding the forces behind its rise is where the real edge lies. As we wrap up, do you agree with James Lavish's take on Bitcoin peaking in 2026 instead of this year? Why or why not? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to subscribe.